Which will make you richer, a SEP IRA or a solo 401k? Well, one way of looking at it is saying it really depends. Hey there, my name's Kenneth French. I'm with vastsolutionsgroup.com, where we do tax finance and artificial intelligence to lower tax liability for entrepreneurs. And a lot of what we do are setting up qualified plans. Sometimes there is a great way of lowering tax liability and also helping business owners save for retirement. You know, the government does help you by providing tax deductions for, generally speaking, for both SEP IRAs and also solo 401ks. But now, and let's get into specifics right now. So, with both SEP IRAs and solo 401k plans, yes, you get tax favors. Now, what do we mean by that? They create tax deductions for the money that you invest in the plan. They grow tax-deferred, so annually you don't have to worry about paying taxes on those plans, either, again, SEP IRAs or 401ks. And at the same time, you only have to pay taxes when you pull the money out of the plan, let's say at retirement, depending on certain criteria. I'll give an example. Let's say you invest $1,000 in your retirement. Let's pretend you're in the 40% tax bracket, combined federal and state, and you earn 10% on your investments. At the end of 30 years, you have, believe it or not, $1.58 million, roughly, off the top of my head, in after-tax spendable cash, which comes from, we're talking round numbers. So, $1.2 million in after-tax cash from the retirement plan, $2 million gross, minus your 40% less in taxes. We're taking the entire amount, let's say, in the plan as an example. $380,000 in the side fund, created by investing, let's just say, $400 in monthly tax savings, i.e. $1,000 deduction at 40%. If you had no government help, so meaning you didn't invest in a qualified plan, that being a SEP IRA or a 401k or a solo 401k in this example, well, you had no government help on the taxes and invest in $1,000 a month in an investment that earned 10%, 6% after tax, that means you would have a little more than $950,000. So let's look at, what's best? $950,000 or $1.2 million? Yeah, I think you get it. The winner, obviously, would be the retirement plan. Wins by a lot, right? By the way, just think about that. That's a lot of money that after tax, or as a benefit to you as a business owner, because you've been able to save money all the way along the line. And again, what we're talking about is at the end of 30 years, you have $1.58 million in my math in after-tax spendable cash, which comes from the round numbers that I mentioned already, the 1.2 and the 380,000 in the side fund. So now that's the big picture. It tells you that tax advantage investing multiplies profits. So then the question is, why don't you do it? Well, let's talk about it and figure out which plan is for you. When it comes to picking, a retirement plan, you have a lot of choices. You really do, generally speaking, as an entrepreneur. If you have no employees in your business, specifically, none of the choices are bad because you're putting money away and you're getting deductions generally. So let's start there, and let's say you have no employees, okay? And let's say further that you're going to choose between, again, I keep talking about it, the SEP IRA or the solo 401k. By the way, as a one-person business, you can operate as a C or S corp, single-member LLC or sole prop, and still have either a SEP or solo 401k. But by the way, we almost never say you should have a sole prop or sole proprietorship. So let's talk about the ease of setup between the two. The SEP IRA option is way easier. There's no rocket science required to establish a 401k at the same time, though. You do have to pay attention to the solo 401k requirements because there are some, and they do change. But in general, your trustee or someone who can help you as a consultant keep you in compliance. So, and there's this thing, speaking of compliance, there's this thing called the Form 5500. There's various different variations of them, but it's one filing requirement you need to pay attention to because your 401k balance, when it raises above $250,000, or you have an employee, though we're not talking about employee plans, you must file that form each year, and usually a consultant helps you with that. And usually, it's at a pretty low cost, generally speaking. It could be anywhere from $1,000 to $2,500, depending on the circumstances. Now, what I would say is, even though you're still going to have to do the tax filing, but it doesn't take that much time for you as the business owner, especially if you have a consultant helping you. Now, the SEP rules don't require you to file the 5500. Now, why choose the solo 401k? Because I said it's a little bit more work, There are reasons to choose a 401k, a solo 401k for one. If your goal is to stash away as much as possible, then a solo 401k probably might be the option that's worth you looking into. With a solo 401k, annual deductible contributions to the business owner's account can come from one of two sources. Let's talk about that. So, source one, you doing elective deferral contribution as the business owner. For 2021, you can contribute to a solo 401k $19,500, and for 2022, you can put away or defer $20,500, and you can add on a little bit more if you're 50 years or old or $6,500. Your W-2 income, if you're employed by your own C or S corp, or your net employment income if you operate as a sole prop or a single member LLC that's used as a flow through entity. Now, source two, your business, your employer contributions. On top of your elective deferral contribution, the solo 401k arrangement, it allows an additional employer contribution of up to 25% of your corporate salary or 20% of your net self-employment income. So let's look at it this way. For purposes of calculating the employer contribution, your compensation or net employment income is not reduced by your elective deferral contribution. Think about that. So with a corporate plan, your corporation makes the employer contribution on your behalf. So the company is putting in money for the employees. With a plan set up as a sole prop, which we don't normally suggest, or a single member LLC, remember flow through, you're effectively treated as your own employer. Therefore, you make employer contributions on your own behalf. Okay? Now, here's one thing to think about. A SEP IRA has a long leg, if you will. With a SEP, you look at the employer contribution only, which is 25% of your W-2 if you operate as a corp or I should say as a corporation, or 20% of your self-employment income, which is adjusted. So let's give an example here. So let's say, off the top of my head, let's call him Braden. My son's name is Braden. He earns $19,000 and he's doing freelance work as an independent contractor. Under solo 401k, Braden would be able to contribute pretty much all his $19,000 in net earnings to a solo 401k. Now, in his SEP IRA, he can contribute only $3,800 because it would be 20% of the $19,000. Okay? So there it shows you a huge difference between the two. So, high income. So let's talk about that. So let's say you're under age 50 and your income is, on the higher side. Let's say, and let's use 2021 numbers because you could still set up plans for 2021, even 22. Your ceiling on your contributions, $58,000. But if you're age 50 or older, the solo 401k has what's called a catch-up provision that I kind of alluded to earlier that allows you to contribute another $6,500, creating a maximum 2021 potential of $64,500. Now, the SEP IRA does not allow such a catch-up contribution, so you can't put in nearly as much into a SEP as you can a 401k. So the planning point of a 401k is thus. You can put away a lot more. So let's talk about just general takeaways, okay? So the key to big retirement plan savings is to really start early, obviously. One, you get growth on the tax savings, generally. And then also, obviously, the earlier you start, hopefully the better your rate of return because you're investing over a long period of time. You don't have to invest very aggressively at the end of your retirement when you should be investing a little bit more conservatively. So the more money you can invest, well, of course, the better off you are just in general. You have several retirement options. We've already talked about them. We talked about SEP IRAs and solo 401ks and the difference. So again, SEP IRA, typically easier and cheaper to set up than a solo 401k. With the solo 401k, you have to file a Form 5500 once your plan assets grow to a certain amount. And in most cases, the owner of a one-person business can sock away more money for retirement with a solo 401k than they can with a SEP IRA because the solo 401k allows both the employee elective deferral and the employer contribution. So, if you have any questions about this stuff, we deal with this at vastsolutionsgroup.com all the time. We're always dealing with this. Typically we're helping our clients to put away huge sums of money into qualified plans, retirement, et cetera, et cetera. Most of our clients are entrepreneurs. Usually in the high net worth arena. Anyway, if you have any questions, give us a call. Check us out on the web at www.vastsolutionsgroup.com. Or, of course, you can give us a call at 888-808-8278, extension try 700. Any of our extensions will be able to help you and point you in the right direction. Once again, my name is Kenneth French. I'm on the board of vastsolutionsgroup.com, and I'm glad I was able to at least help, spend a little bit of time helping you as an entrepreneur understand the differences and planning strategies for using SEPs and also solo 401ks.